This is definitely the closest I've ever felt to the internet bubble, but I would guess that it is nowhere near as frenzied, euphoric, and rabid. But we probably are. I wrote quite a bit about this actually, looking at history, comparing this investment cycle to the past ones. The total capital spent for the telecom bubble was something like $900 billion in today's dollars. I don't think we are even remotely close to that. And that includes some M&A, right? There's a lot of debt, there's a lot of leverage. But that whole investment into the ecosystem for the internet pretty much made the business models of Google, Facebook, I guess you could say Amazon possible. They needed all this infrastructure and build for this to happen. And so I wrote about this in this history piece, essentially comparing the tech bubble to now. But the thing that's actually really scary is if we're going to put it in today's dollars, it would be a lot larger. You can argue that from that perspective, we're early, maybe from other perspectives, the fact that no one has really shook out a really good business model. I don't know when it happens, but eventually it will turn. At the end of the day, I do believe that AI will be a societal changing product eventually.
Yeah, no question. We got to figure out who captures the value. I think there's a big debate on who captures the ROI on CapEx spend. And I think that's one reason why Meta's price dropped on earnings, although it's closed half the gap from that 15% drop. And real briefly on valuations, I have a chart here showing the valuations today of the S&P 500 versus 2021 peak and .com peak. We are in higher altitude territory. We're not yet at the 2021 peak. We are not at the NASDAQ peak. So in NASDAQ, you had a forward PE of 24. Today, you've got a forward PE of 21. And the key thing is earnings growth. If you look at from a PEG ratio perspective, this is looking at the PE ratio divided by the growth rate. There's nothing like a bubble whatsoever. For example, today, PEG ratio 1.32, .com peak, almost twice as much, 2.4, and in 2021, 2. So the key is earnings growth. If the earnings growth is there, there's no bubble. If the earnings growth is not there, we have a bubble. Of course, what ended the .com cycle was Cisco failing to hit their earnings growth targets.
I would actually argue that it's a little bit more nuanced than just Cisco hitting its earnings target. Interest rates were a big part of it as well. Don't forget that 97, essentially long-term capital management went under. And so what happened was Greenspan essentially did an emergency cut because of the fear that there'd be an international currency crisis, okay? The telecom/internet bubble was hot in 96, 97. It cooled down a little bit on the first, as LTCM and the Asia financial crisis really took its toll. But then interest rates dropped and then things went really insane. I would argue that it's pretty hard to have a capital formation bubble when interest rates have gone from 0 to 5 or 4.25% in the last year. And we've had all this investment. Now, the things that I think could really make things get silly and where it becomes extremely uneconomic is, let's say we go through a real rate cut. What would that do to the marginal dollar of cash on the balance sheet of the big five?
I think it's well said. Higher rates, you discount tech firms, and that impacts pricing. I'd say the other thing is back in the .com cycle, we had too much fiber, dark fiber, global crossing that was underutilized. We're putting fiber between countries, underwater, across the states. Wasn't being utilized. There's a difference. Today, every GPU is sold. One day there will be a glut. And as you know, semiconductors are highly cyclical, but GPUs where we stand today are not cyclical. We needed the GPUs yesterday.